For this episode, we shall take up the following 10 accounting principles that accounting practitioners are bound to comply with or observe. The 10 accounting principles are economic entity, monetary unit, time period, cost, full disclosure, going concern, matching, revenue recognition, materiality, and conservatism. For better appreciation, we shall discuss each of these principles and give examples where it is applicable. Number 1. Economic entity principle. Although for legal purposes, both the single proprietorship business and the owner are considered to be one entity, please take note that for accounting purposes, the single proprietorship business is distinct and separate from its owner. It is on account of this principle that the merchandise taken by the owner of a grocery store, for personal use or consumption, is considered as a drawing or deduction from his or her capital, if the corresponding value of the merchandise will not be paid for by the owner from his or her personal funds. Number 2. Monetary unit principle. This means that only transactions in US dollar amounts can be included in accounting records. It is further assumed that US dollar purchasing power has not changed over time, meaning, the effect of inflation is ignored. Thus, for example, dollars from a 1970 transaction are combined, or shown, with dollars from a 2020 transaction without regard to the prevailing inflation rates on the two periods. Number 3. Time period principle. This means that financial statements may be prepared for distinct time intervals notwithstanding its length, whether or not it is shorter or longer provided the time interval is indicated in the headings of the financial statements such as the income statement, statement of cash flow, and stockholders' equity statement. Thus the intervals may be weeks, months, quarters, a calendar year, or fiscal year. Number 4. Cost principle. This means that items are reported in the financial statements at the amount originally spent to obtain or acquire them, regardless of the time the purchase transaction happened. It is for this reason that the amounts shown on financial statements are referred to as historical cost amounts. Appreciation, if any, of the cost or value of the item will just be part of the disclosure or notes to the financial statements. Number 5. Full disclosure principle. This means that significant or important information to an investor or lender using the financial statements must be disclosed within the statement or in the notes to the statement. This is the reason why some financial statements have numerous pages of footnotes that are often attached to it. As an example, let's say a company is named as a defendant in a lawsuit that demands a significant amount of money and it is not yet known whether or not the company would win the lawsuit. Following the full disclosure principle, the information about this lawsuit must be fully described or disclosed in the notes to the financial statements. Number 6. Going concern principle. This means that a company is assumed to continue in operation to achieve its business objectives and commitments and will not discontinue or close shop in the foreseeable future. It is under this principle that some prepayments like insurance, leasehold improvements are allowed to be allocated to future accounting periods. In the event that the accountant has reason to believe that the entity will not be able to continue due to financial or operating challenges, the same situation or condition must be disclosed in the financial statements. Number 7. Matching principle. This means that expenses are reported when the corresponding revenue is earned and reported, whether or not it is already paid. And this is done by the company applying or using the accrual basis of accounting. For example, the salary of contractual sales personnel, during promo sales activities, even if it is not yet paid, must be recorded as an expense by accruing it on the same accounting period that the revenues on the same activities are earned and reported, in compliance with the matching of revenues and expense principle. Number 8. Revenue recognition principle. By applying the accrual basis of accounting, this means that revenues are recognized and reported in the income statement in the same period the product is sold or the service is rendered, regardless of whether the money is received or not. For example, ABC Inc. A construction company secured a contract where the term indicates that the contract price of $5,000 will be paid 15 days after construction. If ABC Inc. completed the construction in just a month, say September 1 to September 30, 2020, then ABC Inc.'s income statement for the month ending September 30, 2020, must record the revenue of $5,000 although the contract price is not yet paid as of September 30, 2020. Number 9. Materiality Principle. This means that amounts that are immaterial or insignificant may be allowed in recording transactions. To illustrate, the materiality principle allows a multi-million-dollar company not to apply the matching principle, meaning the entire cost of $500 CCTV camera is expensed outright in the year it is purchased. The justification is that it would not be considered misleading if $500 is expensed in the first year instead of $100 being expensed in each of the 5 years that it is used, because the $500 is insignificant or immaterial to a multi-million-dollar company. Number 10. Conservatism Principle. This means that when an accountant is faced with a situation where a choice between two alternatives must be made, she is duty-bound to choose the alternative that will result in lesser net income or less asset amount, as a show of objectivity or unbiased judgment. For example, an accountant may write down inventories that have devalued, meaning to amounts lower than its original costs, but it cannot write up inventories that have significantly increased in value or higher than its original costs.